I'd like to start a discussion, just a discussion of the real subject matter, and that's chapter 3. It's going to be relatively light. So there is this tax formula, and when you get this book, if you open it up, and I of course destroyed it, ripped things out, but the first page you'll see is this page, and it's the most valuable page there is, because first it starts with the tax formula. And what it is, these are the steps we'll be covering this course and figuring out how the income is taxed, how we get to taxable income, how we get to that tax base, which we'll be talking about. But it's like a funnel. We start very wide, and it's going to narrow, 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 narrow down, okay? And become more and more narrow. So ultimately, whatever we start with, we're going to end up with the most important line, and that's taxable income, because that's what's going to get taxed. Okay? And there are different chapters covering different points, but I'd like to start just this discussion with you. So we start with income broadly defined. What does that mean? It means whatever you get, whatever you receive as a general proposition, whenever in doubt or not in doubt, the code says from whatever source derived, okay? That's what's going to go into your formula. Could you give me examples of what you could receive during the year? Salary. Bonuses. Gifts. Tips. Capital gains, which we'll talk about when you receive on sale. Winning lottery. Anything else? Money you get selling drugs. Gambling. Is it legal or illegal? Both. Okay, so we'll study all that stuff. So it's anything and pretty much and everything broadly conceived, with the exception of two items. First, borrowed money. Okay, the money we borrow doesn't get into taxable income because it's not your income, right? You guys are accountants. When we get the money, you debit what? I just want to make you feel at home for a while. It's like, oh, thank God we're going to talk about debits and credits. So you get the money. When you borrow the money, you debit what? Cash. You credit what? Liability of some type, right? So there's no net change on equity or income, right? Oh, thank God we're talking about accounting. This was crazy. Okay, so borrowed money. Another example, second exception, is return of capital, meaning return of your own money. Maybe you lent money to somebody last year, and now they're giving back to you your own money. Is that income? No. No. Now, the interest on it could be income, but we're not talking about that. Just your own money back. Okay? So broadly defined is everything whatever you get minus these two items, okay? Less exclusions. What are exclusions? Exclusions are items of income which the government said they're not going to tax. What are the examples, some of the examples of exclusions? Yeah, certain tax-exempt bonds, income on tax-exempt bonds. You have the whole list of them in your book. It's Exhibit 3.1. Okay? We're going to study accidents and insurance proceeds, bequests. That's when you receive money when somebody dies. Okay, you cry for a long time, and then you realize amount is not taxable, so it's not as bad anymore. Which part again? Bequest is when somebody dies, you receive the money. For income tax purposes, it's not taxable. But we already said some state laws could tax it, right, as inheritance tax, right? Different tax, different level of taxation. Not by federal rules, bequests are not taxable. The money you receive when somebody dies. Okay? Child support, not taxable. Gifts, a big deal. Gifts received, not taxable. Wait a second, now I'm confused. Professor, didn't you say before that gifts are taxable? And now you're saying they're not taxable? Come on, make up your mind. Which one is it? Which one is it? The key word is it depends.
Depends on the person. Like, is he giving or receiving?
Good point. But there's a bigger point.
It depends if it's more than 14,000.
Guys, you're so good. Yes, we are good. We are so good. Yes, but it really depends on whether we're talking about income tax or gift tax. Remember, government came out with gift taxes. That's when you get this whole discussion. Did you give? Did you receive? 14, 15,000 a year. Income tax, never. Thank you. You're still good. Okay? You can receive $1 billion. It's not going to be taxed as income tax. You understand? So when I say gift tax, government can with gift taxes. If you make a gift somebody, you're going to pay tax in certain situations. But whoever receives the tax, there is no income tax on that. And we're here to talk about income tax on individual from federal perspective. That's why the initial conversation was very, very important. We got to zoom in. We're talking about specifically federal income tax for individuals. Under that taxation formula, gifts received, not income. Exclusion. Is that clear? We have a separate class called estate and gift taxes, and there we study gift taxes. Different story. Different systems of taxation. Different rules. We're good? That's why the key answer is it depends. What are we talking about? Whom are we talking about? What amount are we talking about? So you have lots of excuses for clients. When they come to you and they ask you questions, you say, it depends. I got to do some research. It's about $500 an hour. And so on and so forth. So these are exemptions, okay? Again, exemptions are items of income for which the government says we're not going to tax you, okay? After that, we get into the deductions. A beautiful world of deductions. You're going to love that world. Why? Because as you notice, these amounts are in brackets. That means they decrease this amount, which means the more of these amounts in brackets, the lower the taxable income is going to be, right? The less taxes you're going to pay. Good stuff. The more money you keep in your pocket. More money in your pocket is a good thing or bad thing? What? No, it depends. No, it doesn't. I told you, it doesn't work in all cases. Let me make it clear, ladies and gentlemen, you're in a business school. Okay? What are we studying in business school? The primary. All right, we're not going to go there. More money, keeping everything else equal, is better. You don't believe anything anybody tells you. Okay? Keeping everything else equal, more money is better. There's a lot of debate. Does money make you happy? Does it not make you happy? I have a simple answer for you. Having money may not make you happy, but not having money for sure will make you miserable. We have some friends who come to us. They like these esoteric conversations. We had dinner last year. They're like, you know, their study came out. I said, yeah. And studies show that people with more money actually live happier lives on average. I'm like, no way. No way. You mean when you could do whatever you want, travel all over the world, have whatever you want, give your kids whatever you want, it's not going to make you happier? Wow. Yeah, it's true. You could be miserable if you have a lot of money, but then you're going to be miserable no matter what in life. Then you have to work on your perspective on life, right? Because happiness at the end of the day doesn't come from anywhere. I mean, it's all internal stuff, but having money makes it easier. So let me get that out of the way if that wasn't clear. Send me letters of disagreement. It's like questions about marriage. She passed away recently. What's her name? She and her daughter had a talk show, Amy's or whatever. They were Emmys. They were. Oh, Joan Rivers, right? Long time ago, she was asked like about her advice to her daughter about getting married. And she said something along the lines of, I don't care whom she's going to choose to marry. It's completely her choice, as long as she hangs around exclusively among millionaires. Or something along these lines. Very interesting stuff. Anyway. So deductions are the things that decrease your income. Deductions are expenditures you make during your life. Are you spending money while living? On what? Food. Clothing. The most basic stuff. Can you get a deduction for them? No. Not deductible. First rule you'll learn, generally speaking, personal expenses not deductible. So your food, your clothing,
How about rent?
rent, not deductible. Whatever you had for breakfast, for dinner, whatever beautiful clothing you're wearing, not deductible. Rent, not deductible. But then you're going to learn, but mortgage interest is deductible. So maybe it's better to buy your own place and get some deduction out of it. Or we're going to learn maybe it's good to do some business at home and get deduction now of rent because they're already used for business. Oh, it gets interesting. Oh, maybe for breakfast I should invite my colleagues. We should discuss some business stuff. So it becomes business meal, it becomes deductible. Oh my God, this stuff is really interesting. I could make some money here. And you never eat food alone from that point on. So we'll talk about all that stuff. But there are two types of deductions, you'll notice. It's deductions for adjusted gross income. And it doesn't matter how it's called, but we call them for adjusted gross income. I don't know why. To arrive, I guess, at for adjusted gross income. Because next is the line called adjusted gross income. And then there are expenses called itemized deductions, right? There's also the next set of expenses known as deductions from adjusted gross income, right? So deduction for adjusted gross income and from above adjusted gross income line, below adjusted gross income line. Sometimes we even refer to them above the line deductions and below the line deductions. Line being adjusted gross income line. Why is it called adjusted gross income? Why is it called gross income? Is there anything gross about it? I don't know. That's how we call these things. And they get adjusted. You could call them Mary gross income. It doesn't matter how you call it, really. Except for the exam, of course. So above the line deductions, also known as for adjusted gross income, there are a bunch of examples we're going to study. Trade or business expenses are above the line deductions. IRA, pension contributions, above the line deductions. Moving expenses, above the line deductions. Okay? We'll study them. Alimony payments, above the line deductions. Wait a second, Professor. I'm confused again. I get a question sometimes. Professor, I'm confused. Why are you confused, my dear? Because if you look at partial list of items that are part of gross income, you have alimony here, right? Along with awards, bonuses, dividends, and other good stuff. But then when we talk about deductions, you told us deduction is actually above the line deduction for alimony. So I'm confused once again. Which one is it? Is it in gross income or is it deduction? Let's go back to our expert.
I was going to say it's in both.
It's in both. What happens if you put amount above and then below? It's going to cancel out. So it can be both. There's no point. So where does alimony amount? You guys know, by the way, sometimes after this class I get questions. Sometimes. What's alimony? I know we got some immigrants here. Oh, did I tell you I'm also an immigrant? I already told you that. Much like many of you, when I just immigrated, when I was in school, I was sitting with a dictionary. I do allow dictionaries and exams, but paperwork, not electronic. Okay? So sometimes I get a question. So what is alimony? For those of you who don't know, it's a price of saying I do. When you get married, because when you say I don't later, then you have to support that person possibly for many long time, for many years. So alimony is actually payments to your ex-spouse. Okay? Because while you were in school, getting educated, and were getting a great job, your husband was sitting home washing dishes. And then after you graduate, you say, why am I married still? And you get divorced. Well, somebody's got to support your husband. And it ain't going to be his girlfriend. So that's what alimony is, okay? So which one is it? Where does alimony go? Is it part of income or is it part of expense? Come on. What's the answer? That's right, it depends. Are you paying it or are you receiving it? If you receive, that's income. If you pay, that's a deduction that government allows you. You got it? That's it. It's that simple. It depends on which side you are. Is it better to pay alimony or to receive alimony? Not a tax question. All right. So that's as far as where's our tax formula. So that's above the line deductions. Deductions for adjusted gross income. Okay? Then we have adjusted gross income. Very important line item, adjusted gross income. A lot of financial institutions look at it as your true income in deciding should they give you a loan, should they not give you a loan. Plus, a lot of other tax benefits are given to you by the government as a function of your adjusted gross income, as you'll see later. So the higher your adjusted gross income, the less help you're going to get from the government. So a very important line item. That's why we call it a line. So deductions before above the line, after deductions below the line. Is that clear? We're good? So moving forward then, the government then, once you get to adjusted gross income, look what it says. Less the greater of total itemized deductions or standard deduction. Oh my God, oh my God, oh my God. So what are itemized deductions? Again, you go to your textbook, Exhibit 3-3. Ladies and gentlemen, if I may point your attention, direct your attention to Exhibit 3-3. These are examples of expenditures for which the government decided to give you tax benefit. Some of them even personal, like medical expenses. Right? State and local income tax, real estate taxes, interest and home mortgage, charitable contributions, casualty losses, and theft losses. We'll talk about that. Okay? So like medical expenses, everybody gets it? You could always deduct it? No, it says in excess of 10% or 7.5% of at least 65. So in order to get benefit, for example, from medical expenses that you incur, you got to be really sick. How sick? Relative to your adjusted gross income. If you're very sick but not sick enough because you make a lot of money, no deduction. Seriously. And what does this work? How does it work exactly? I know you guys love numbers, right? It's like, come on, give us something to calculate. We're accountants. So let's say your adjusted gross income, AGI, is $100,000. Oh, by the way, I need to apologize in front of all of you in advance. Can I do that? I have a secret to share with you. I have horrible handwriting. I have a perfect excuse for it. Would you like to hear it? Seriously. I'm lefty, right? But I come from former Soviet Union, and there in my 5th or 6th grade, they decided that's the wrong way to write. And they retaught me to write with my right hand. So now my handwriting is equally horrible with both hands. But these guys completely messed me up. Actually, seriously. Now, I don't know what I am anymore. Like I play tennis with my left hand, but I serve volleyball with my right hand. I play guitar as a righty, but I eat as a lefty. Like it's weird stuff. So anyway, my handwriting is horrible. Okay? But that's 100,000. So that's your AGI. And let's say you incurred, I don't know, $15,000 in medical expenses. Okay? So question, let's say you are 70 years old. How much can you deduct? That's a question on exam. Answer, A, 15,000. B, 10,000. C, 0. D, some other number. Answer, D, some other number. Why? Because if you're so I told you you're 70, right? Well, you want to keep it simple? Let's say you're 50. So what percentage applies? 10%. What's 10% of adjusted gross income? $10,000. That's the amount you cannot deduct. That means you're not sick enough relative to your income. It's a floor, not deductible. It's anything that's above that floor becomes deductible. So you incurred actually 15. The floor is 10. How much is actually deductible? $5,000. Any questions? If you're 70 years old, the percentage is going to be not 10, but what? 7.5, in which case the floor is going to be $7,500, in which case deduction is going to be $7,500. Right? Any questions? Comments? Friendly remarks? Not so friendly remarks. We're good? Excellent. So going back to the list, you'll see, you already see example of certain expense that's function of your adjusted gross income. You see casualty and theft loss is also function of adjusted gross income. Some other, it's 2%. We'll study all these things. But that's why it becomes important what your adjusted gross income is. The higher amount of adjusted gross income, the less of these expenses you could take, right? Because the floor becomes bigger. You guys follow it? Because when you apply percentage to the adjusted gross income, that amount becomes bigger and bigger the bigger your adjusted gross income. Now, they changed their mind. They heard something about percentages, said, no, that's not for me. So, but going back again to the formula, it says something interesting. It says, where are we? It says it's the greater of two amounts, itemized deductions, which is what I gave you, or standard deduction. What is standard deduction? Standard deduction is comprised of two amounts, basic and additional. And it's also in your book, so don't worry about it. But it's an amount given to every taxpayer or family. And the government says, up to this amount, we should not tax you. So it's a deduction also, right? It's the amount that should not be taxed. We may get into the story behind it. But as you'll notice a few interesting things here. First thing you'll notice that this amount changes from year to year, right? So for example, if you're single, in 2015 it's $6,300, and you cannot see it. And now you can. Okay? You also see that it's a function of what's known as filing status. Oh my God, there are such things as filing statuses here. And you'll notice there are a few of them. Single, married filing jointly, surviving spouse, single but dating. No such thing. No. Head of household, and married filing separately. We'll study what these filing statuses mean in future classes. But for now, you kind of could guess, right? Single is when you're pretty much alone for tax purposes. You know, you're going to learn an amazing thing. For tax purposes, you could be married and single at the same time. So for those of you who are married in this room, and I know who you are, I could tell by looking in your face. Somebody sent me an email of photos of presidents when they became a president and after. You know, the face like ages in double speed. Like you see them 8 years later completely wiped out. It's different with married people. It's much worse. No, I'm kidding. So, but seriously, those of you who are married, you may be single for tax purposes. So technically, if somebody asking you and you say, I'm single, it's not quite lie. I forgot this is being recorded. My wife may listen. Okay, so we'll study that in separate classes, okay? But you'll see single people get $6,300. Married people, for example, married filing jointly, get double that, $12,600. Ooh, that's interesting. That's very interesting. Sometimes I get a question. I do a lot of lectures, actually, throughout the country at times. And I remember, I'll never forget, I was giving this lecture about planning, estate planning, asset protection. you know, the whole stuff. And this, after the lecture, one gentleman comes to me and says, I'm sorry, I have one question. Like, so what's the benefit of getting married? So I explained there are a lot of benefits. But one of the benefits you'll immediately notice is that you get double standard deduction, right? So let's say you'd like to meet somebody, but you don't know how to start a conversation. I'll teach you how to talk to people. Soon, not yet. But I'll let you think about it, how you could use your knowledge of tax law to improve your personal life. Okay, there is surviving spouse. That does not mean somebody who's been married for 10 years. It means when spouse died, 2 years later. We'll study that too. Okay, so that's known as basic standard deduction. But there's additional amount given to you. Okay, and that's not, again, being married every 5 years to get additional star. No. So there are two categories of people who get additional amounts. People who are 65 or over, or blind. Okay? So if you're 65 or senior citizen or blind, you get additional amount. Again, if you're single, $1,550. If you're married, filing jointly, it's $1,250, and so on and so forth. Each person per category. So very quickly, a test. You guys ready for a test? If you're a single person, in 2015, well, let's say 14 to make things easier. And you are 70 years old. What's your total standard deduction? I don't care about the amount. How do we go about it? So we take single, 6,200, right? Plus you're 70, that's 1,550. Right? So what does it come out to be? $7,750? Okay? And if you're blind and 65, how many times do you add this? 2 times. For each, you get $1,550 for being blind and for 65 and over. You got it? So next time you see elderly couple walking around together, both blind, you're like, that could be just tax planning. I'm kidding. Bad joke. You understand? Any questions on this? Yes.
When does head of household apply?
When you are head of household.
Right, but if you're married and you're filing...
We're going to study. We're going to have the whole class on what this means. Yeah. But head of household generally is when you're not married, but you have a dependent. So we'll study all that stuff. For now, we're painting broad strokes in this beautiful painting. Now remember, the most amazing thing of it all, the government gives you a choice. It's the greater of, where are we? The greater of total itemized. So in case you're wondering, what does itemized deduction mean? You go item by item. The expenses for which the government allows you deduction, you total them up, mortgage interest, property tax, medical expenses, all that other stuff, right? You say what the total is, and you compare it to your total standard deduction, whatever you're entitled to, right? And you pick the bigger one. Oh my God, that's wonderful. Because your itemized deduction could be 0, and you still get total standard deduction. Or your itemized deduction could be $30,000, in which case you pick the bigger one. You got it? Pretty powerful stuff.